So here we go. Hello guys, and glad to have you on board again today for our first recorded live room practice session. This is a new stuff for these new 2021 to 22 season introductions. Much more targeted educational content. Today is fully going to be all about trending contexts. So if you are a green or white level into the Discord, meaning that you're just beginning using my strategy, well, this session is not for you guys. Okay, so all about trend. We don't talk about range. I don't answer any ranging question. The only thing I care about is trending contexts, assuming that you know how to position each and every third range boundary that we might find into these trends, and all of those things. Okay, so let's get it started. We don't pay attention to this market because, well, that looks like a range, or looks like a trending range actually, but range, okay, no trend. The only potential trend we could get comes from this area, in which we can see that our moving average has been setting for a few for a few updates right below a rising context. Anyway, not enough for us to consider this, as it looks like this trend has neutralized. So we've got something in between. But we'll set that topic aside and talk about trending ranges or alternate trend structure and other day. Today we're going to keep it simple, as it is the first one. So we're going to take the same example as the one we've taken with the French guys earlier today, and we're going to start rolling over Solana, because Solana is the topic of the moment. This is the new revolutionary cryptocurrency that's going to change the landscape. It is a skyrocket. It's rising too fast, so people are willing to short sell or whatever. It's overpriced, it's a bubble. So we're going to try setting things aside and finding the real market context for these things, because of course there's a trend, so we're going to apply our trending rules. The goal in here is to let you understand, as always, that with a definite set of rules that you repeat just as it is over time, okay? It's really the same old stuff, okay? Repeat same and same and same and same rules over and over and over and over and over, okay? It's really analyze, process, repeat, analyze, process, repeat, analyze, process, repeat, and over time this will turn out to be kind of an automatic reaction, which means when you have a look at a market, you'll be able to process information in a few seconds, which is what I do. Personally, I don't need more than a few seconds to figure out what market context is it likely going to be. Okay, anyway, let's process you guys around doing these things automatically down the road. This is a long process, which means you have to get familiar with the process itself. You have to practice it a shitload of time, and then it will get automatically processed. Are we all agreed on that? At that point. So today we set the basis, and then over the next few weeks we're going to repeat that same bullshit as long as necessary. And we're going to take some specific use cases in which we're going to find some weird stuff, okay? We're going to find some context in which the rules are not 100% met. We are going to dive into shaded gray territory as we scroll through multiple assets, so you'll see the gradients, the whole beauty of the variance we'll have in market structures. Still, we're going to be able to find reliable answers using a simple set of rules. Okay, so what I've tried to achieve with this strategy, whether that is for ranging context or trending context, is to try finding the tiniest numbers of rules that gives us the highest level of market contextualization in quite a variable market structure. Okay, markets can take so many variants. So what I try to do is to sum up the core information out of these market structures into black and white rules, so that with as little rules as possible, you're going to be able to contextualize as many market contexts as possible. Still assessing the fact that just like with third range boundaries, there's always going to be chaos around the corner. You cannot analyze 100% of the markets. There will still be 20 or something between 20 and 10% in trending context in which the market will just do shit. And there's no other way around but to accept it, and I hope you've already understood that at that point, because that's what you're supposed to have fight against on ranging contexts. Okay, so stop trying to make sense of irrational behaviors. Just try to see if the market meets some of your rules, and if it does not, change the context, change the time frame, and try to find one that does. All right. Any question at that point? No one? Can someone at least just say hello to make sure that I'm not just talking to no one? Damn it, no one? Maybe I'm not in the right place. Okay, you're in the right place. All right, so we're fine. Okay, let's keep it going. I assume no question means I'm crystal clear, so I keep it going. All right. So, do we have a trend in here? Yes, rising moving average on top of a rising context, below a rising context. So, we've got things. All right. So now let's try to sum up the core information. Before going any further, the only thing we've done here is to build the core structure of a decision-making process, okay? Which is always based on set of rules that are not shaded gray, okay? The first set of rule comes with black and white answers. These are the pre-requirements before using any trending context rules or whatever, okay? Shaded gray areas come down the road. There's no shaded gray into the number one rules that you need to meet. They are four of them. These are the rules you need to meet exactly in order to use the strategy down the road and dive into shaded gray territory. Okay? So 4 sets of rules that need to be either validated or invalidated. And if the rule isn't validated, that means we have to do something, either changing the context, switching time frames, or just pass. But please do not apply the strategy unless you can validate the 4 rules. Which are those 5 rules? 4 rules, but not 5. Not necessarily listing them in a definite order, just spit them out. Which one of the rules do you know? Don't fear saying something wrong. No one gives a fuck. So just spit it out. Which one of the 4 core rules of trending behaviors do we need to study? Come on, don't just wait for someone else to answer. Try it out. No one's going to judge.
Rising moving average.
Rising moving average. Okay. So I want the core rules to be as specific as possible. So what we care about is
no context.
No. It's just the moving average itself. Okay. Which means looking at the moving average will help us confirm that we are into trending context. Because the difficulty we have above the third range boundary stuff and ranging context is that in range context, it's black or white. Either we can apply the ranging structures and the ranging rules, or we cannot. And then there's only one thing. If we can use these rules, then the only thing we care about is the third range boundary, because there's only one tradable context in ranges, the third range boundary. And it can take multiple forms, but there's only one tradable context. Not the case for trends. In trends, we have multiple tradable contexts due to multiple maturities. Because we can either be building accumulation, which is not a trend, but it's a preparation of the trend. We can trade the breakouts. We can trade the trend followings. We can trade the pullbacks. And then there is the final excess that we need to be able to assess as well. So in order to fully, confidently assess that the market is in this maturity or this maturity, we use 4 things, okay? The first one of these 4 is the one you just mentioned, the moving average, okay? So let's just write it down, okay? This is 1. What are the others? 3 left, so just try it out. What else do we use in trending contexts? Fibonacci's not in core rules. We use the Fibonacci's within some specific contexts, but to make it straightforward, okay, why not the fibs? Because the fibs are used in some contexts, like the pullback, for example, But that's it. Do we use the Fibonacci's in final excesses or divergences? No, we do not. So Fibonacci's are used on specific contexts. But the whole thing, Fibonacci's, we don't necessarily care about. It's not one of the mandatory top 4 stuff. We're definitely going to use fibs, but not now. Here we're talking about the preliminary stuff that we need to check before going down, trading any of the contexts we could find. So we study the moving average because the moving average can and likely will, most of the time, invalidate trending contexts. I'll try to find some examples. But first I want to... Oh boy. Oh, not good. Wall Street is not going to like that. Okay, so 10-year yields are breaking up. Oh boy. It's going to be a rocket ship session today. The VIX is rising as well. Oh boy. We'll see. Higher highs, not necessarily. Try it out.
Raising context.
Yes, eventually we'd use the context, but we use the context not in the 4 rules. We always use the context. I mean, the context boxes are used in every context. Basically, that's why they called context boxes. So I could count them as mandatory, but I mean, we always study the context. Like, for example, we'll study the moving average position regarding the context, as an example, but I wouldn't put it into the top 4. Yes, that's one of the conditions required. Okay, the moving average is one thing that we're going to study to validate the probability of a trending context to truly be there. So it's more like considering it that way. We're not going to necessarily look at validation of the context, but we're going to look at each and every one of those 4 things to avoid applying contexts that may not be the ones we look for. We're going to look for divergences, things that do not look good for trending contexts. I'll show you examples later, okay? So moving average is 1. Mature range preceding is another one. Okay? The fact that any trending context you want to profit from must be preceded by a range. For example, if this is a trend, okay, which looks like it is, the moving average is doing its job correctly, okay, we are preceded by a range, so this can very likely be a trend, but there are other things we need to fulfill first. So a breakout, yes, but try to be broader. Try to have a broader vision, okay? In here we set the core elements we look for, not to just highlight the breakout, but to highlight every intermediate context of trends that we know about. So try being just a bit broader on your vision. What do you use to define a breakout, actually? Because that will give us another of the 4 answers.
Go about context and trend channel.
And there is also one other thing that we need. What do we do when we break out? We break contexts and we also break
Trend channel.
cycles.
Oh, cycles, right.
Okay.
Yeah.
So we definitely, on trending context, always going to pay attention to the trend cycles. Okay? When you trend trade, I want these trend cycles to be turned on. You don't need the local time frame sine wave, okay? But the trend sine wave must be turned on. So if you trend trade, this is the setup you want to have. Trend sine wave, not the local time frame sine wave. This one isn't necessary, and that would just over-cluster the chart, okay? So cycles is another of these answers, okay? Because cycles will use them to define maturities of the trending context. In breakouts, we want to see cycles broken, okay? Cycles do not terminate their bearish oscillations. That's one sign that a breakout occurred. Then if the trend fully fulfilled itself, we want to see the bear cycle fucked off. The market should be destroying each and every intermediary cycle by just, having flatline stuff. which we have. So in here, in terms of moving average, cycles, and preceding mature range, do we fulfill all of those informations? Yes, we are. So in here, we're supposedly going to use our trending context without a problem, but still there is one additional final stuff, which is, what is the latest core rule that would filter out our use of trending contexts in the current charts? Because actually, right here, right now, we will definitely validate those three guys, but the fourth one isn't going to pass. So which one is the fourth guy? Try me out. Don't fear spitting out a bad answer. Signals. Signal is when signals comes down the road. Okay, so in a specific order, when we talk about the strategy, okay, the first question you want to answer is, what is the damn context I'm dealing with? Okay, once you got that answer, okay, once you know which context you trade, then you're going to look at the requirements to trade. Though you're going to look for the speculative area using the contexts and so on, okay? And then once you get into that specific area, you're going to look for signals. And depending on the signals, you're going to define which risk management you use. Are you going to go aggressive, maximum risk taking, tight stop loss, or are you going to go more defensive, like I'm going to go with a larger stop loss, tinier position sizing, or I do not have sufficient information, I'm going to wait, or at least I'm not going to do anything now. Okay, this is the requiring process of trading. But first, we talk about context. So what we're doing here is far above looking at signal. At the current given time, the only thing we pay attention to is the trend cycle. I haven't even given a fuck about the momentum. Momentum comes way, way down the line. Not now. So try thinking about really the broadest possible set of rule that is meant to do one thing. Tell you which maturity of the trend you could be into, and making sure you're looking at the appropriate time frame to use your trading rules. So which one do we miss? I practically gave you the answer. Yes, we always gonna have to look at the higher time frame, +1 at least, most of the time even +2, to make sure that we're not trading inside a bigger time frame range, for example, or to make sure that we're not trading in multi-time frame trends. Because if we do trade multi-time frame trends, which means we're going to use multi-time frame rules, which is something I haven't yet recorded. So never mind, if you never found this answer, I totally agree with that. It's my fault. I'm going to do this as soon as possible. This is top priority, to record the multi-time frame set of trading lessons, okay? So I'm not going to talk about multi-time frame trends today, but to give you just the core rules, okay? This is why we zoom out every time we go into time frames, okay? Every time we go into trending context, we always, oh damn it, going to have a look, damn it, okay, come on, I wish I could have done better. Is it going to work? It's deleting everything, sorry guys. Okay, so all right, let's put it that way. Okay, we always need to have a look at the higher time frame. 1 time frame above is absolutely required. 2 time frames will generally be helpful. Okay, so you never ever break one of these rules. You never ever trade any supposedly trending context that you know, like accumulation, breakout, divergence, pullback, final excess. If you ever use any of those contexts without verifying all of these, not just 2 or 3, all of these, you're going to make mistakes. Okay? So this is why we always do these things. So let's put it into real market context using the big boy Solonis trend, because this is one great example of multi-time frame trend. So today is going to be a good example for you guys. Okay? So we always follow these set of rules, because if we do not, that means we're going to dive into chaos territory, which we certainly do not want. We want the market to be as crystal clear as possible, because if it's too chaotic, then that means we're taking too much risks, which we're supposed to do quite the opposite. We are risk managers. We're supposed to reduce risk taking, not increasing it. Okay? All right. Let's move on. So let's do our job. Moving average, that's the first thing we validated. In here, it's a pretty simple black or white answer. Is the moving average inside the context, though are we still in ranging context, or is the moving average pulling below the context, and so on. So in here, we definitely are into trending context, advanced trading context, because the moving average is already below. So luckily, the breakout has already occurred. So we'll confirm that later. Do we have a mature range proceeding? There's no doubt in here. It's yes or no. All of the pre-requirement rules are always easy. Yes, so we've got the premature, the mature range proceeding, so we're good. Okay, we're good with this guy. Good with this guy. Next, cycles. Okay, we clearly have failed to terminate this cycle in here. This one also terminated, also failed to terminate, and now we do not even have cycles. So are we past the breakout? Yes or no? Yes. Okay. And these cycle breakouts, do they confirm the fact that we've installed the trend? Yes. So any conclusion we would go down to is the fact that the breakout maturity is already past. Okay, so breakout is due. Can you see it? Well, yes, it's definitely over these areas. This is where we've broken above the resistant context. This is where we've broken cycles, and so on. Okay? So we have all the requirements to tell us that a trend is going on, that this trend is already into intermediate maturity stage because we've already passed the breakout. So we're going to study the rest of it. Do we have a pullback? Yes or no? Okay, so what would be the requirements for a pullback? Using cycles, moving averages, and so on. What's telling us that we have the likelihood of a pullback? I'm not talking about the context, okay? Trading a pullback context requires a context positioning, below 50% context, and so on. But before even thinking about it, what should it look like in terms of these things?
Slowing down trend, divergence.
No, we could see a divergence, but using those things, okay? Do you care about the preceding range? Of course not. It's not really useful in a pullback context. It's just there to confirm the fact that we have a trend. What could the moving average look like when you are in a pullback? Is the moving average still rising? Yes or no?
Absolutely.
Absolutely. So a rising moving average is one requirement for a pullback. If you see a falling moving average, man, there's a problem. Okay, you should definitely change the time frame. You're probably not in the right stuff. Okay, so we're past the breakout. So whatever happens next is the pullback. We know that because that's what we've learned with the strategy rules. There is a definite order for a trend. So if we apply our trending context in here, pullback is past. Next one is, breakout's past. Next one is pullback. In a pullback, we can trade moving average prices, but the moving average has to remain rising. Okay, some pullbacks dip below the moving average. Most of the pullbacks don't. Okay. Okay. What could the cycle look like in a pullback? Trending cycle. Okay. The pullback is the first time in a trend in which we hesitate. So normally the bears should have their opportunity to trade. So yes, we would like to see a bear cycle terminating itself. Okay, like going into terminating a cycle for a little once in a while. It hasn't been doing it so far. So normally cycles in here suggest that the pullback is not yet there. Might very well come sooner or later, but we're not yet there. Okay? So cycles in here says, well, we still have a bit of a time to go for the pullback. Now we have one final thing to go, and this is a mandatory stuff. Right here, right now, on the 15-minute chart reference, we've got one thing to talk about. The market looks like it is on the verge to pull back, but there is no emergency situation in which it's going to happen immediately. Okay? So we can contextualize our market. The next move is the pullback, and it's going to come rather sooner than later, but there's no immediate emergency for this. We have the answer that we wanted. Still, does that mean we can trade it just like that? Absolutely not. Yes, anyhow and anyway, if you ever trade a context that is trending context, whether, I don't care the maturity, okay? If you ever trade that without looking at the higher time frame, at least sometimes 2 time frames above, you're making huge mistakes, okay? So let's go for it. We go for 1 time frame above. Sorry about that, it's not necessarily useful. Okay, so what do we have here? Put it simple, okay? Still using the same old stuff, okay? We're not trading the context, so we don't give a fuck about details, just the broad picture. I can even delete prices, you don't need them. So, first thing we'll look at, because that's pretty damn visible, okay, the moving average. So moving average is far below rising contexts. The context is even unfolded top and bottom at some point. So, well, that looks like a pretty damn exotic move, okay? So we might be in excessive market territory, okay? What could be the maturity? Do we have a mature range proceeding? Yes, in here the market has oscillated across the moving average, the context, but the moving average, did it even range at some point? Did we have moving average inside the context? No, it always has gone below, still rising like shit, to the point that we're now getting pretty damn excessive. So in here, can we apply any of our contexts, our trending contexts? It doesn't fit the plan. Anything that happens in here is way too excessive, so please don't apply trending context to this thing. It is way too big. This very likely could have been a pullback, but damn it, that's hell of a bullish pullback. So anyhow and anyway, we cannot fit the rules we need to apply our contexts, our trending contexts. So anyhow and anyway, zoom out. If the rules doesn't apply clearly, and you cannot bend these 4 rules, in here you can definitely see that there is a problem with the moving average. I'm not even looking at cycles. In here, all I can tell is that the moving average itself, yes, I have a mature range, but damn it, the range hasn't even valued. It's really just that we temporarily gone flat and gone up again. So anyhow and anyway, it looks way too excessive. We need to go for the higher time frame. All right, that sounds a lot better. Okay, that sounds a lot clearer in here. The moving average is rising and it's getting below the context. The context is rising and both of the boxes have been unfolded multiple times in the past. Okay. Is it preceded by a mature range? Yes. Is the moving average inside the range? This time, yes. So that tells us that the market has broke out of this range. So can we see the breakout? Look at the cycles. Cycles are okay. Oh, damn it. We've got a hell of a problem. Cycles are broken. In here, multiple time frame cycles broken. These ones are the local time frame cycles. Okay. This one is the trend. So we've broken short-term cycles and we've broken long-term cycles. There's definitely our breakout phase. Okay. All of this is not shaded gray territory. It's really black or white. Looking at all our reference things, the moving average, the cycles, the preceding range, we can definitely say that we have a trend. How mature? We've passed the breakout. Are we on the verge to pullback? Well, there is no such a thing suggesting that the pullback occurred, so we are in between the two. We are past breakouts before pullback. Are we okay with that? That's basically the same thing that we've seen earlier in the 15-minute chart. Okay? All agreed with that? If there is any confusion, tell me about it. Because I haven't yet recorded anything like multi-time frames, so if you feel like you're totally lost, that's normal. That's normal. I'm introducing this stuff to you guys today, so if it's too complicated, don't mind. It's normal, because we haven't yet recorded the full educational stuff about that. So some of you guys might hear that for the first time. But anyhow and anyway, you must be able to get to this conclusion right now. Everyone must be able to see the breakouts, the preceding range, the value rising, the moving average setting itself below the context. So we definitely have a trend. The trend is definitely setting itself, and the reference time frame is very likely 4-hour chart. But before going any further than that, I need to zoom out to make sure that there is no trend on the higher time frame as well. We're already in multi-time frame trending right now because the 15-minute chart is trending, H1 is damn excessive, and we're trending 4-hour. We need to make sure that we're not trending daily. Okay, so we just zoom out and go daily. Oh boy. Do we see a range? Oh, where's the moving average? There is no moving average, not enough history. Do we see a range? Well, could be one in here, but that's pretty damn fast, and that's the same range we've seen on the lower time frame, so it's pretty much the same stuff. So can we do anything with this time frame? Well, not really. I would say this one lacks of history to go further down this road. So we're not going to do anything on the daily chart, so we go back to where we were before. 4-hour is our reference time frame, and this is a trend, so we're gonna be trading these time frame. Okay, so right now we know what to do. We are past breakout prior to pullback. So what do we do on this market? This is our range. The range has validated and confirmed because we've made the 1-to-1 ratio. So range broken, validated, confirmed. What do we do when the range is validated and confirmed? No, we trend follow. Okay, so we definitely trend follow. Let me put the prices back on. Okay, so this is where we validated, confirmed. So in here, very likely we've had a trend followed opportunity, either because we touched the moving average 2 time frames below. Okay, so 4-hour reference means we're trend following in the 15-minute chart. Oh, that might explain why the goddamn 15-minute chart looked so crazily excessive earlier, right? That's the reason why if you do not zoom out to the higher time frame, most of your trending context may look dumb or excessive or irrational, or the logic of trending structures simply don't behave, mostly because you're probably in multi-time frame trends. Okay, so multi-time frame trends creates a lot of chaotic shit on lower time frames because these reference time frames are both trending and being the trend follow stuff of the higher time frames. Okay, so you're going to see multiple pullbacks in the 15-minute chart because any of those pullback is going to be a trend follow goddamn opportunity on the 4-hour chart. Do you get that now? It might be a bit complicated, but think of it that way. Anytime there's going to be a range on the 15-minute chart time frame, anytime we break out of this range is going to be a 4-hour trending following opportunity. Anytime you retrace to a 15-minute chart moving average, it's going to be a buying opportunity to the 4-hour chart time frame. We also know that we generally have to replicate these perspectives 2 times and no more. We don't do more than 2 trend follow. So we very likely had one in here, probably had a third range boundary in here, needs to be assessed. Let's try to answer that question. So moving average, I can definitely tell you that we found one. So there was one, so validation was in here, if my memory is right. Yeah. So here we had the validation confirmation, first buying entry in here with a stop loss below the context. So that would have been this. You would have bought in here, waited for this whole fucking long time, but had a nice entry anyway. Then where do we leave the area? Where's the next time we've built a third range boundary? In here, third range boundary breakout. Nice. Okay. Oh, there might have been one in here actually. Let me just zoom in closely. Oh boy. Yeah. Okay. Third range boundary in here, squeezed, pullbacked. So next thing we do as trend follow, we buy the third range boundary retracement. So here's our second trend follow. Okay, if you wanted, you had the third one in here with the moving average shot once again. Okay, so plenty of opportunity. Otherwise, you had the third range boundary breakout in here. You had another third range boundary in here, another breakout opportunity, another trend follow in here with the moving average. Lots of things. So multiple trend follow that all worked, suggesting probably we have a time frame on the higher time frames. Because if we have more than 2 to 3 trend follow, means this is something that likely happens on the higher time frame as well. At least this is one of the things that should be suggested to you. Okay? You know your rules. You know that a normal trend offers generally no more than 2 trend follows. In here, you have like 4 or 5 right in front of you. And I'm not even counting the first ones we had. So that should suggest that there might be a trend follow on the H1 time frame as well, which should suggest that maybe the trend is also occurring on the daily chart. Okay? Might sound a little bit confusing, guys. So if you are, don't get me wrong, this is definitely orange stuff in here, not yellow, okay? Managing multi-time frame, leveraging positions, and so on, multiple trend followings, this is definitely some orange stuff, okay? So if you do not understand it all today, never mind, you will later. It takes some time to process. These are complicated stuff because you have to come and go, switch up and down, and manage multiple time frames at once. This requires some mental gymnastic that none of you guys might get in the first place, okay? We take some information and we extrapolate this information and what they could mean on the high time frame. The fact that I see multiple trend following opportunity that all worked goddamn fine suggests that people are buying on the daily chart reference. We've got our story, guys. Okay, so let's sum up everything we've done for Solana. It has been complicated because we've gone from yellow territory right up to what orange guys should be able to do in the end. Okay, we've processed quite a lot of information, but what you need to take out of here from today's episode, something that every one of you guys must be aware of, the number 4 set of rules. Number 1 rules by the set of 4 that you need to know exactly and to meet at every given use of a trend following opportunity. Okay? What are the rules? What are the things you look at? And these are mandatory stuff. You cannot miss one of them. The 4 ones have to be met to know that you are in the good reference time frame for your trend. There could be multi-time frame trends, okay? But you always need to follow the higher time frames ones. Though, for yellow guys, the daily one, you don't trade it because you don't have enough information. You trade the 4-hour reference until further notice, and for now you wait for the pullback. For the orange guys, we have gathered information on the 15-minute chart time frame, which is supposedly the 4-hour trend follow, and we've seen a lot of discrepancies, problems. So we somehow have hints that the trend follow might as well play its game in H1, which means we can eventually forecast the probability of our trend to even extrapolate to the daily chart time frame, which means we still have a lot of potential down the road because we would need to have a daily pullback and a daily final excess, which means, whoa, let it ride, folks, let it ride, okay? Are we all agreed on that? The daily chart trend follow is absolutely reserved for orange guys. Yellow guys, you need to find out the other conclusion, which is trade the 4-hour charts. All of the 15-minute chart trend follow opportunity has been met already, so you do not trend follow anymore. You wait for the damn pullback. Okay? Are we all good with that? If you can do this analysis on your own, means you're goddamn ready to trend trade on your own. Not with fully opened leverage and so on, but if you're able to do the same mathematic on your own, means you're good enough to trade alone on trends. Of course, you need to practice a lot to trade with tiny amounts first, so you get familiar with the trending biases, so you don't fall for them, okay? And slowly but steadily, you'll get better and better. You'll be able to trade multiple structures like that, and with this very tiny set of rules, okay? We've not even talked about trading the context, but just finding the context to trade by finding the appropriate time frame to look for these contexts. If you do that, that just took 4 fucking rules. And it took me 5 years to bring it up to those 4 rules. Because adding more would make it more complex, but taking down one of these rules would seriously destroy the risk limitation. So this is the easiest thing I could have gone down to. 4 fucking rules that will help you do what you need to do the best possible way. Finding the goddamn context in which you need to apply your rules. But before applying the rules, find the context. And to find the context, you need to follow these goddamn 4 rules. They will inevitably bring you to the appropriate time frame to trade. And they should give you the answer about the trend maturity by just 4 fucking rules. And if you find any other trader out there that has made it simpler than that, well, he's real good. I'm not saying I'm the only one. I'm saying I've made the best I could, and it took me 4 fucking years to get there. I've always used those stuff, but I mean, I wasn't nearly trying to put them into videos or PDF manuals and so on. These are things I've naturally used all the time. I mean, now I'm teaching these things to you, so I had to make it understandable to you guys. This is the easiest thing I could have gone down to. I can't do any simpler than that. And if you use it in the right way, in the right order, you're going to make it right, okay? Use these 4 sets of rules to define the appropriate time frame, find the appropriate maturity, and then, okay, when you found your appropriate time frame, found the appropriate context you're going to be trading, okay, then you're going to use your context rules, okay? In a pullback, you trade below 50% context with this level of Fibonacci's and so on, okay? These are the trading rules of the context, but you need to know the context first and to be in the appropriate time frame to trade it. Once you get to the speculative area, which is positioned both horizontally by fibs, okay, or dynamically by the contexts, okay, you're going to look for signals right at the end of the process. And signals are both momentum, breakouts, and so on, okay? But this is the order in which you do stuff. Find the appropriate time frame by following the core rules that will lead you to the place you need to be. And they will pull you out of the areas where you shouldn't look at. So you can find the appropriate time frames to trade on. Once you find it, define the maturity. Once you've got the maturity you're going to have to trade, apply these maturity set of rules. Once the set of rules are met, means you're into the speculative area to risk manage trading this context, and you're going to do it by gathering all of the risk limitation signals that will help you monitoring how big you want to trade this, to take this trade. Do you have sufficient information to trade it at all? If you do not, then you're just going to pass. If you have partial information, you're going to trade it but with less exposition. If you have no signal, if you have tough signal, meaning all of the signals requirements are met, god damn it, you go full shot. Still following the damn rules. Each and every of the contexts have a limited leverage exposition, 2% maximum risk per trade. Don't ever dive beyond this level, okay? And you've got everything you need. You've got a clear set of rules that lead you from a market, which can be as crazily unique as every other market available out there. Each market is unique, but if you follow this set of rules, you will end up with a consistent decision-making process that leads you to what you wanted in the first place. Do I have to trade? Yes or no? But you don't just decide if you wanted to buy or sell. You follow the set of rules that told you if you have to, and if you have to, what do you have to do? Which context are you trying to exploit? What is the associated risk if you trade that thing? Are you even looking at the right time frame? These are a shitty lots of questions that most people don't even ask themselves. They say, well, this looks like a trend, let's buy. Great. Go for it. If that's how you trade, good luck on you guys. You better have to be trading a real solid multi-time frame trend to be successful. Otherwise, well, you're probably going to be down the shit. Because you have much more defined mindsets and vision of what you're doing. You have a goddamn plan. You know where you buy, for what reason, you know how risky the trade is, you know what you target, you know what's the next move is going to be. Oh boy. And most of the time you're going to trade on different time frames than the shittiest traders out there, which just, I mean, it's rising, so it's going to keep rising. Let's buy. Great. You see that you're definitely much better than the average trader out there. And, well, now you might understand why the money flows from the dumb guys to the smarter guys. Because the more you trade, the more money you make. The more they trade, the more the average return is close to zero. Sometimes they succeed, they make a shitload of money, but most of the time they fail and they lose what they've gained. So, it's a draw game for them. It's basically gonna go average over time, depending on luck. Today they're lucky, they're making money. Tomorrow they won't be lucky, they will lose money, and time will pass. Well, if time passes for you, and if you still trade with the same old fucking set of rules and you repeat, okay, apply, trade, repeat. Filter, apply, trade, repeat. Filter, apply, trade, repeat. Okay? Find the context. Wait for the speculative area, look for your signal, trade, risk manage, because once you got into the trade, there is risk management. Where do you validate the trade? Where do you take partial profits? Okay, all of those things are sets of rules that you're going to have to learn down the road. But learn it the right way. What's the most important and cannot be avoided is this set of 4 rules that I taught you today. This is what you need to remember from today's video, because we're just going to repeat that shit over and over again each and every week after week. Okay? See you guys 7 days from now. We're going to do the same shit over again. I'm sorry to say it. It's going to be boring because that's what trading is all about. Yes, this is all recorded and I'm going to add it into YouTube right after. Possibly not today because I have a real tough schedule and I might have to leave right after recording the next session. So, well, probably by tomorrow, okay? Great. Yeah, I know you needed these lessons, so we're gonna do it and you'll see. Today might have been a long shot with lots of information and it might sound, well, too complex to you guys. Don't mind it, okay? A few weeks from now, as we repeated the same shit over and over again, this will start to be a lot clearer than it was today. Bye, guys.